Right. Assalamualaikum and good afternoon. In fact, good evening already or something. So for today, we're going to continue with topic number 3. Okay. Let me check on the recorder. It's recording. Okay. So for topic number 3, we will still talk about risk and return. But as I said last week, today we will focus on the portfolio side. But not forgetting what we've done last week. So it will be recapped again today because the earlier parts of portfolio risk and return, we still need to calculate the risk and return for the individual securities. Okay, because some information for our calculations under the portfolio risk and returns require information from the individual measurements lah, in terms of their, especially in terms of the risk elements. Okay, and in fact, together with the return as well lah, when we want to calculate the portfolio returns. Yeah, guys, okay. Okay, so some background assumptions. So we want to, when we want to calculate some analysis, obviously we need to do some assumptions. Okay, so here we will see some assumptions that we need to do in order to analyze the risk and return. Okay, so number one, we will assume every investor will want to have this to maximize the returns. Right? So we need to assume this. In real world, yeah, obviously every investor obviously want to have a profit, okay, or positive returns. Okay, but there are certain cases whereby a different investor might have a different level of expectations. Okay, but for these assumptions or for this analysis, we will assume everybody will have the same, okay, similar approach with regards to maximization of profits or maximization of returns. That's number one. Okay, and they will assume that the ones under our calculations will be the only assets and liabilities that they have. Okay, meaning assuming that there will be no other assets involved. So every assets will be part of the portfolios. That's another assumptions. Okay, even though in real case maybe it's not the case, but yeah, but for our assumption here, we will assume every assets and liabilities will be part of the portfolio. Okay, so this is some recap with regards to expected rates of return. For individual asset, okay, for individual asset is from what we've discussed last week. Right, we measured returns, especially for the expected returns, the ER, with the formula of the sum of probability multiply with required returns. Okay, so if we have 3 probabilities, we need to multiply each probabilities with the required return at different level. Okay, and then we total up everything to get the expected returns for individual. Okay, so that's why it is stated here. It is equal to the sum of, which is the sum of, my symbol here, the potential returns multiplied with the probability. Okay, so this is what we've learned last week, and we will revisit this again today. Okay, but for the portfolio part, okay, for the portfolio parts of the expected returns, we're still going to use the ER. Okay, we need to have the ER's information from the individual assets. Okay, remember when we talk about portfolio of investments, we will have multiple assets. Okay, we're going to have multiple assets. So meaning if you want to calculate the portfolio, the expected returns of the portfolio, we need to calculate individual assets first. Then we combine it in the portfolio calculations. So meaning we need to have this ER of individual assets first. And then we're going to use what we call as the weighted average. Okay, last week we've discussed about arithmetic mean and geometric mean, okay, which is the simple average for arithmetic mean. So there's another part of average or mean here, which is known as weighted average. Okay, so when we want to measure the expected returns of a portfolio, we are actually measuring the weighted average, the weighted mean, okay, of the ER. Okay, but here, the ER, we will not use the simple average. Simple average means if you have two assets, what we need to do, if we're using simple average, we just add and then divide by 2. Okay, that's simple average. But when we want to measure expected returns of portfolio, we need to have the weight, hence the name weighted average. Okay, so the weights, okay, will be represented, by the value of each asset. Okay, each asset we divide with total assets. So that's how we measure the weights for each investment portfolio, just for the sake of explanation. Let's say I have 100,000 ringgit. 100,000 ringgit. And this 100,000 will be divided into 2 investments. For example, stock A, stock B. Okay. So from this 100,000, let's say I put 30,000 here. 30,000 in stock A. So the balance of 100K is 70,000 here. 7% lah, 70,000 70K. 70,000. Right. So when I set the weight for each stock A and stock B, how to identify this is by having the value. So for stock A, the value of investment or the value of asset is 30,000. We have to divide it with the total value, which is 100,000. So 30 divided by 100, it's 30%. Okay, I just use a simple figure so that it's easy to calculate. Yeah. And for stock B, obviously, it would be 70%. So this 30 and 70% is what we call as the weight of each investment. Okay, so these weights, okay, will be represented in our expected returns of the portfolio. So that's why if you want to see the formula, so still ER, expected returns, but with this initials of PORT stands for portfolio. Okay, so expected returns of portfolio is the sum of, again, the sum of, we have W here. Instead of P for the individual assets, we use P, probabilities. Right, but for the returns of portfolio, we're gonna need the weight. Okay, similar like probability, the weight, when we add every weights that we have, it must equate to 1 or 100%. Okay, similar like probabilities. So since we have, let's say, 30% and 70%, okay, so we will have 2 levels. So meaning if you want to find the expected returns portfolio, it's weight 1 multiply with return of stock A, for example, and then we add with weight number 2 multiply with return for stock B. Then we add the total figures to get the expected returns of the whole portfolio. All right, and this RA and RB is technically the ER of individual assets. Okay, ER of the individual assets. So that's the measurements of expected returns for the portfolio, right? The main difference between this part, ER, the sum of P times required return, is the individual asset, we use probabilities. for the portfolio return, we use the weight. Okay, and in order to calculate the portfolio part, we need to calculate the individual ER first. Okay, so this is ER basically, yeah, ER of stock A and also stock B. Okay. Any questions? Okay, if you unsure of anything, just let me know. Just prepare this one. Okay, and besides the notes that I share with you, I think you recall juga lah, I also share for topic number 3, exercise. Okay, so for today, let's try question number 2. Okay, this is how the risk and return question looks like. It will combine both individual and also the portfolio, the risk and returns valuations. Okay, so they will give you again a probability with a different state of economy. So, and this probability, like I said, when you add everything, it will equate to 1.0, 1 or 100% if you convert it into percentage, and with the different rates of returns. Okay, and how to read this? Basically, from these 3 probabilities, the most likely chance would be normal, state of economy normal, with a high chance 40%, whereas boom and recession with a 30% each chances to happen. Okay, the higher the probability, the higher the chance it will happen that way, like in terms of the state of economy. Okay, so it's quite balanced. It can be any state of economy because the rates is quite equal from one to another. Okay, and here we have 2 stocks, stock A and stock B, with the different rates of return. Okay, so the one in the bracket represent negative return. So meaning for stock B, during recession time, you may end up have a negative returns. Okay, but both during the boom time, during the what we call the best possible economy, they have, offers the highest rate possible, 32 and 50% respectively. Okay, so before we calculate the portfolio, as I said earlier, we need actually to calculate the individual stocks risk and return. Okay, so that's why if you see the question, it starts off with find the expected returns, okay, the expected returns, and also the standard deviation for each share, So meaning for stock A and stock B, individually, not as a portfolio yet, as an individual instruments. So this is what we've learned last week. Okay, so to test our, memory with last week's lesson, okay, let's do this together. Okay, try to put it side by side like so. Okay, so this is for question 2. Question 2. Right, so the first part, they ask about the expected return, the ER, expected returns. And we're going to do the first one for stock A first. Okay, this stock A. Okay, so if you recall the formula, I also just wrote down earlier the formula. It is the sum of probability multiplied with the returns respectively. So meaning, if you want to calculate for stock A, it will be 0.3 multiplied with 32% plus 0.4 multiplied with 20%. Right, and we add with 0.3 with 1%. Okay, so grab your calculator. So based on my calculation, it will be 17.9%. Okay, 17.9%. Okay, so this is what we've learned last week, for the expected returns for individual stocks. So now we try to calculate the expected returns for stock B. Okay, for stock B with these rates of return, but with the similar probabilities. Okay, so we just substitute the one in the bracket according to the B's information. Okay, for example, 0.3 multiply with 50%, okay, which is during the boom time, plus 0.4 with 16%, right? And the last 0.3 multiply with a negative, negative 5%. So here we get 19.9%. Okay, by the way, if you have any discrepancies with my calculation, just let me know. Maybe I miscalculate, maybe wrongly calculate, just let me know. Check your answers. Don't take my answers as it is. There might be some errors. Okay, but although I doubt it, but just check if there's any. Okay, so that's the first part of the question. Okay, find the expected returns for each share. So these are the answer. Okay, we have 17.9 for stock A and 19.9 for stock B. Okay, so we move on to the second part, which is the standard deviation. Okay, standard deviation. Okay, and again, if you recall last week's lessons, in order to calculate the standard deviation, okay, we need to find the variance first, because the symbol of standard deviation is sigma, right? So from variance, sigma squared, we have to square root the variance in order to get the standard deviation. So therefore, we need to find the variance first. So let's say we want to find the variance for stock A. Okay, variance for stock A. And we're still gonna use the probability. Okay, but instead of multiply directly with the required returns, okay, possible returns, we're going to multiply with the difference. Okay, the difference of possible returns with the expected returns, our answers earlier. And then we have to square it. Okay, square it. For example, for stock A, it will be 0.3, okay, multiply with the difference of 32% minus with 17.9% square. Okay, so that will be our first level, plus 0.4. It just follow through the levels return, yeah. So the second level is 20%. So it's 20% multiply with, minus with 17.9%. You don't forget the square, because remember, for variance, we don't have negative figures. So that's why we have a square here to eliminate the minus or the negative values. Okay, because there are some values, for example, the last one here, 0.3, 1% minus 17.9%. Because if you don't square this, 1 minus 17.9, obviously we'll get a negative value, right? So we don't want that. Okay, for variance, the value is always positive. So please, can you calculate for me and let me know what will be the variance here? Value. 1.47. Okay, 1.47. Okay, if you do manually using calculators, you might getting this value 147.09. Okay, this is what I get from my calculator. But if you want to convert it in percentage, okay, what you need to do for variance, this figure you divide by 100. Okay, you divide by 100. Okay, instead of multiply 100 to get percentage, but for variance you divide by 100. So meaning you get 1.47 percent. The square is only for percentage. Yeah. Depending on how you use it, for myself today, I don't use the percentage. I just calculate 32 minus 17.9. Okay. Then multiply with, square and then multiply with 0.3. That's why I get this figure first. Right, and you can leave it as it is, 147.09, or you can write as a 1.47%. Okay, but it's not 147% lah. Okay, it's not 147%. Okay, so this would be the answer for variance lah. So to find the standard deviation for stock A, simply square root, I will square 147.09. So I'll get around 12.13%. Okay, 12.13%. So that's the standard deviation for stock A.
Doktor, may I ask a question?
Sorry?
Nak tanya, kalau
Yeah.
semua jawapan memang kena dalam percentage
Which one?
Contoh, semua jawapan memang kena dalam percentage ke?
It's not necessarily to write in percentage lah, but yeah, because untuk return memang obviously in percentage. Okay, the return CR obviously in percentage. For variance you can use either one. Okay, as long as you don't interchange lah, maknanya kalau 147.09 acceptable, but don't write 147% lah. It's not 147%. Kalau you nak write in percentage, make sure you divide by 100 dulu untuk dapatkan in percentage. Okay, so if you ask me, perlu letak percentage for all? Not necessarily, but put it according to the actual numbers lah.
Contoh kalau yang standard deviation tadi tu kan, tadi
Which
saya
one?
kira untuk standard deviation, tadi saya kira variance tu, saya kira dapat percentage yang 1.47 tu. Jadi kat standard deviation tu, saya punca kuasa yang 1.47% tu lah.
3% ni.
Jawapan kalau standard deviation tu, kalau yang saya bagi tu dia dapat 0.12. Kalau tertinggal
0.12. Yalah, itu maknanya the answer of 0.12 is not in percentage yet.
kalau tertinggal jawapan yang tu tak apa ke? Ke kena juga kalikan?
If you put 0.12 without the percentage, it represent, kalau you letak 0.12 apa tadi, katakanlah 1213 kan. So this is technically is the same as this one. Tapi kalau you letak ni, sama tak? 0.12% dengan 12%.
Tak sama.
So be careful lah.
Okay,
As long as you know the number represent percentage or not. Kalau you tak sure, you don't put lah.
Okay, terima kasih.
Right, but meaning kalau you just leave it as it is, this is actually 12.13%. Okay, so the conversion is this part, 12.13%. But yeah, so that's how you write lah. Okay, so that's for A, for stock A. So let's try variance. Okay, variance for stock B. Okay, the same process. Okay, can you try to calculate while I'm writing here? Try to calculate, which is the same process as stock A. So minute is 0.3 multiply with 50% minus berapa? ER 19.9 squared plus 0.4, 16% minus 19.9% squared plus 0.3, negative 5% minus 19.9% squared. Okay, find the total. Square is only for percentage. Yeah, I explained already. This one. Okay, for myself, like I said, how I calculate, I don't put 0.5 minus 0.199, for example. I just use 50 minus 19.9 and then square and then times 0.3. And then you will get the huge number in this case. I got it here, 463.89. Okay, this is what I get from my calculation. Okay, or if you want to convert it in percentage, you divide by 100, it's about 4.64%. Okay, 4.64%. The standard deviation for stock B would be square root 3.89. 21.54%. Okay, so that's our answers, right? So let me highlight the important answers. So besides the ER, we need to know our variance, our standard deviation. Okay, this part. So this one. Okay, and all of this, okay, the one I wrote just now, so far, all of this equivalent to 10 marks. Okay, equivalent to 10 marks. All right, but again, this is all based on our lesson last week. This is all basically recap from last week. Okay, we haven't used the portfolio yet. Portfolio actually will be from B and C. Okay, especially C later. Okay, especially when we want to calculate the expected returns for the portfolio. We need the ER for both 70.9 and 99.9 will be used when we calculate the portfolio of the returns. Portfolio returns of the portfolio as a whole. Anyway, any questions so far? Okay, maybe I explain this straight away instead of I'm going to the risk element, which is this part. Maybe we implement this as well in our calculations, in our questions now. But the thing is, in order to calculate the portfolio returns, like I said, we need the weight for each stocks. Okay, weight 1 and weight 2. So if we look back at the question, this question, the weight can be found in section C. Okay, whereby, okay, if you remember, I said in order to find the weight, you need to know the value of the investment. Okay, so for this question, the value would be represented by this information. Okay, the person said they have a portfolio consisting of 40,000 units of stocks A, and current value is 4 ringgit each. Okay, 40,000 with 4 ringgit each values. And for stock B, it's 96,000 with a 2 ringgit and 50 cents. All right, so with this information, how we want to convert this into weights? Okay, so remember the rule, we need to find the value. Okay, so meaning to find, if you want to find value of stock A, it's simply taking the number of units of stocks, which is 40,000 units, multiply with the current value, which is 4 ringgit each. So 40,000 by 4, which is 160,000. Okay, so this is the value for stock A, right? And for stock B, okay, similar concept, similar approach, similar process. Take the value, the number of units, which is 96,000, multiply with 250. So roughly 96,000 times 2 ringgit and 50 cents equates to 240,000. Okay, so this is individual values. Okay, but in order to find the weight, okay, remember, I just recap balik to my notes just now. Okay, to find the weights, the weight here is value of each one divide with the total values. Okay, divide by the total values. So meaning our total values between stock A and stock B, if you combine, it will be equivalent to 240 plus 160 equivalent to 400,000. Okay, 400,000. So meaning to find weight for stock A is basically taking 160,000 divided by 400,000. So it's 40%. 40% here, and for weight of stock B, it will be 240,000. But by again the total value, which is 400,000, so this will be 60%. Okay, 60%. And this would be the weights. Okay, you need to show this calculation, how you get this information. For this question, yes, you have to find yourself the values. But bear with me, if you look in the exercise for topic 3, if you look at the first question, for this first question, the ratio is already given, the weights. Okay, for this ratio, it's already given in this way. So if this is the case, you don't have to calculate this. You don't have to go through this process. Okay, so because it's given here, 40/60. Okay, but this is not the case all the time. Sometimes the question might give you this kind of information. So if the question gives this one, then you have to go through my explanation just now, this process to get the weights. And yeah, coincidentally, the value is the same, 40% and 60%. Okay, so now you have the weights. Okay, by the way, I skipped the process of B first, because we haven't go through the covariance yet. Okay, but since we already discussed the expected returns of the portfolio, so I'm going to show you the expected returns of the portfolio first. Okay, this part. Okay, the expected returns of the portfolio will be, remember the formula is the sum of weights, okay, multiply with the expected returns of each stocks or each assets. So in this case, okay, the weight is 40% and also 60%. So the first one is 40% for stock A, and our ER earlier was 17.9%. Okay, 17.9%. And we add with the second weight is 60%. Key weight for B is 60%, and the ER was 19.9%. Okay, 19.9%. So therefore, again, grab your calculator. So here the average or the expected return is 19.1%. Okay, so this is expected returns of the portfolio. Remember, when we said about expected returns of portfolio, this is basically the weighted average of two returns of two stocks. Okay, this is expected returns of stock A. This is expected returns for stock B. And basically, we are find the average between the two, but using the weights. Instead of 17.9 plus 99.9 divided by 2 as a simple average, but we use the weights instead. Okay, clear? This is expected returns of portfolio. So in order to find this, you need to find the weight first. Okay, this process to find the value of each stocks and then find the weight individually. Right? And once you have this weight, then we can calculate the expected returns of the portfolio, because the ER is already calculated based on the first question. Okay, these two. Okay, any questions so far? Okay, so we've done the portfolio return. All right, so if there's no question, let's move on to the measurement of risk. Okay, measurement of risk. So again, the first part, we will recap what we've done last week for the measurement of risk for the individual assets. We have three measurements here. The variance, okay, the variance, okay, symbolized with the sigma squared, the standard deviation, sigma, and also another thing, which is coefficient of variation, or CV. Okay, so variance and standard deviation, I even showed you just now how to calculate for the individual stocks. Okay, for stock A and stock B. Send tadi, this part, variance and standard deviation for individual stocks. Okay, so for stock A, okay, variance, standard deviation, and for stock B, variance and also standard deviation. The question doesn't ask for CV, so we don't have to calculate coefficient of variation. Okay, but if you have to, then you use the formula what we similar like what we've discussed last week. Okay, if the question asks for the coefficient of variation. Okay, but for the portfolio part, okay, we're going to measure similar. Okay, we still have to measure variance. We still have to measure standard deviation for portfolio, but in order to calculate both, okay, we have to have additional information. Okay, and that information is actually this part, the covariance. Okay, so we will go through the first types of measurement. Okay, in a form of covariance. So covariance, in fact, covariance and correlation is basically is to measure the relationship between the stocks that we have under our portfolio. So meaning, for example, we have stock A and stock B just now, right? So we want to know, to study how this stock A and stock B behave between each other. So what kind of behavior? We want to see how they move, the movement of these two stocks, whether they interact between one to another. So meaning, there are three possibilities. Okay, when we measure covariance and correlation, there'll be three possibilities. Okay, you're going to have either positive relationship, okay, or this is number one. Number two, we might have a negative relationship, or number three, there'll be no relationship at all. So what would be the difference between all three? Okay, for positive relationship, so to measure this, like I said, we have to either calculate covariance or correlation, right? Both will indicate the same results. Okay, number one, positive, it means they will move in the same direction. Okay, they will move in the same direction. Means if stock A, the price is going up, stock B, the price will move up as well. Okay, they will go in the same direction, goes up both. Okay, but if the stock going down in terms of the price, let's say, or the values, stock B will move the same direction, which is going down as well. Okay, so when I said positive relationship, it doesn't mean you will go positive ways only. No, you will go the same direction, either going up or going down. Okay, but if it's negative relationship, okay, they will move inverse. They will move in different directions. So meaning if stock A going up, stock B, the price will going down, or the return will going down, for example. Similarly, it will be vice versa. If stock A going down, then stock B will going up the other direction. Okay, so that what is meant by a negative relationship, and they will move. You know, you can see the movement. Okay, when you track, you can see the movement. Or the third possibility, it will be no relationship, meaning the two stock will move random. There will be no interrelation between one to another. So when we do a portfolio, remember the purpose of portfolio at the first place is to minimize risk. So when we want to minimize risk, we want to make sure we can manage, we can forecast, you know, our stocks. So therefore, out of these three possible relationships, the best, you know, stocks that we need to have in our portfolio must have, out of these three, obviously we don't want a positive relationship, because if it's positive relationship, they will move at the same direction, right? So meaning it will defeat the purpose of portfolio. We want to diversify. We want to avoid our stock to lose money at the same time. Meaning, if both moving up, then that's okay lah. But what happens if our stock returns going down? Okay, both will going down at the same time. So defeat the purpose of diversification, or defeat the purpose of portfolio. So the best is actually to have a negative relationship. But again, the level of strength of relationship is differ from one to another. So you want to have a mild, okay, a mild negative relationship. Okay, mild or weak lah, I can say. Okay, we don't want to have a very strong relationship, meaning when I said strong, meaning they go totally the opposite. It's a perfect, like I said, perfect relationship. So if it's too perfect or too strong relationship, there's a possibility that, yeah, you make money on one investment, but the other will be at the very bottom. You will lose a lot of money there. So again, it will defeat the purpose of diversification. So we want to have a very mild relationship. So meaning when they move, okay, if one of the stock losing money, the other will cover the returns. Okay, so that's again the purpose of portfolio. Okay, and again, these three can be measured either using covariance or correlation, because when we want to calculate the correlation, we need to have the covariance as well. So that's why these two is actually related to one another. You will show the same results, but it's just a different interpretation because the score will be different. Okay, and obviously correlation is much easier to explain because the score is the range of score is very minimal. It's between -1 and +1. But the covariance, the range can be huge. The numbers can be in hundreds even. Okay, and the other measurement is actually beta coefficient. Right. So when we talk about risk, okay, maybe, I'm not sure whether I mentioned about this or not last week. We have two types of risk. Okay, the systematic and also the unsystematic risk. Okay, I will explain again later when we reach this point to explain about the beta coefficient. But for our case, actually, yeah, we will not use this beta coefficient yet. Okay, yet. I just introduced you the concept of beta coefficients. We might not using this for this topic yet, but we will revisit this for sure in our future topic. I can't remember which topic. I think topic. For the capital markets, we need to have the beta coefficients. right? This is another element of risk measurement. Okay, risk measurement. So let's look at the first part. Okay, obviously, like I said, for measurement of risk, we're still gonna have variance and standard deviation. But in order to calculate this, we need to calculate the covariance and also correlation possibly first. So the main part here is this covariance, covariance. And as I said, this is to see the the movement of the assets that we have in our portfolio, right? So we want to see how they move or how they relate from one to another. So move together means they are generally above their means or below their means at the same time, okay? So we have a few options here, or a few options of formulas, right? But for us, okay, we're gonna focus on this part, okay, this formula, the one in the middle, okay. Okay, so if you see the formula, it is actually quite similar like what we've done before when we want to calculate the covariance, if you remember. Okay, if you look at this part, it's actually the sum of P, probability, multiplied with the difference of rates. Okay, but for variance, if you remember, this part in the bracket, you square it. You square it in order to find the variance. Okay, but for covariance, because we want to see the relationship between two stocks, therefore, in the bracket, we multiply between the two differences of the stocks without the square, okay? Without the square, because remember, the covariance have three possibilities, positive, negative, and also no relationship. So meaning for covariance, there's a possibility of negative answers. Okay, there's a possibility of negative answers. So there's a possible of negative. So meaning if we have a negative here, in one of these, automatically we will have a negative values. Okay, negative values. Okay, so this is formula. So if we want to test this formula, okay, bear with me, and let's go back to this question. Okay. So for the covariance, it is in question B, 2B. Calculate the covariance between the two shares. Right. So bear with me, the answers now it's not in sequence anymore. Obviously, this is based on the first part, yang ER dengan standard deviation. This is based on A. But now we going to do for B. Maybe I label it. So I remember now. Okay, so this is for A. So I have to move B down here. Okay, this is for B, for the covariance between the two stocks. Okay, covariance of stock A and stock B. So A and B. So in the notes, I use I and J, right? So you can substitute I and J with the name of the stock A and stock B. Okay, and if you recall just now, the formula would be the sum of, meaning you will have a different level of probabilities, okay, because multiplication of probabilities, the difference of the expected returns, sorry, the possible returns minus the expected returns for stock A, multiply with the difference between possible returns stock B minus ER for stock B, right, for each level. So meaning you look something like this, okay. So this is actually similar like a table format sebenarnya. I'll use like a similar like a table format. So meaning we start off the first line, 0.3, multiply with the difference of first stock. So 32 minus 17.9, multiply with 50 minus 19.9. Okay, the one in the bracket we already done before. Okay, in our variance as I mentioned, 32 minus 70.9 and 50 minus 19.9. Okay, so we've done that before, but no square. Okay, we don't square this. We just multiply all three items. Okay, plus 0.4 is 20 minus 17.9. Multiply with 16 minus 19.9. Okay, plus with 0.3. It's 1, 17.9. Multiply with -5 is 19.9. Okay, and again, please help me to find the answer for this. 127.19. Okay. So dia dapat tadi 127.19. Betul ya? Two five 250.29. So ada dua jawapan ni.
I got 250.29.
250 eh.
Uh-uh.
50.29.
Yes.
I got the same answer actually. So 250.29. Again, similar like variance Similar like variance. Covariance, this would not be in percentage. Okay, this is not in percentage. So if you want to write in percentage, you need to convert this by dividing this with 100%. Okay, so it's about 2.5 lah, 2.5%. Okay, so this is actually 2.5%. Okay, so what does it mean, 2.5%? So the answer is positive, right? So positive. So this indicates that the two stocks, stock A and stock B, has a positive relationship. Okay, positive relationship. You actually can see from the rates itself, actually you can see they are moving up together. So imagine you're looking from normal point of view, normal economy, 20 and 16% respectively. So when the economy is going well, during boom time, both increase in terms of their returns, but the rates of increment to different. Okay, the 20 up to 32%, but the 16 up to even higher at 50%. Okay, but both moving at the same direction, 50%, or moving up at the same direction. And during recession time, both stock A and stock B also drop in terms of the returns. Okay, 1 and even -5. So even from this, actually, before we calculate, we can predict it would be a positive relationship. Okay, just to share with you, for example, if we look at this question 1, again, if you look from the normal point of view, when they move up to good economy, okay, one stock going up from 25 to 40, but the other one going down from 12 to 5. So this one drop, this one increase. Okay, but during poor economy time, this the first stock going up, but the other one going down. So from this, we cannot say this is a positive relationship. So we can predict this would be a negative relationship. Okay, so the covariance might be negative for these two. Okay, if you want to know, you have to calculate later lah, the covariance and also correlation, whether it will be negative or not. But our first prediction, it will be a negative relationship.
Betul. Nak tanya sikit ni.
Yeah.
Macam tu lah, kalau dapat positif, maksudnya dia positive relationship kan. So kalau dapat negatif, dia negative relationship. Tapi
Yeah.
kalau untuk no relationship tu macam mana?
The answer will be 0. Your score ni exactly 0, which is very difficult kan. So if it's actually very 0, maknanya when you add everything, you dapat exactly 0, then it will be no relationship.
Kalau macam 0.5 kau yang tu still
So
relationship
0.5 dah positif lah.
positif.
Very minor lah. But so to get a negative relationship, it must be totally 0, 0.0. Right? So that's why, biar tak explain tadi Positive I already mentioned. Negative also I mentioned. Tapi kalau untuk apa tadi? For no relationship, your covariance must be exactly 0, whereby the movement of the two stocks will be, like I said lah, random movement. There will be no relationship between one to another. Okay, and maybe kat sini tak ada, but when we talk about it in the correlation afterwards, okay, because actually correlation is another variations of measurements of relationship between the two, similar like covariance. But for correlation, we can see the strength. Okay, we can see the strength because the score, like I said, is between -1 to 1 only. Okay, it's not in percentage, it will be in score, in score. So we still need the covariance values. Okay, we already have that earlier. But in order to complete the formula, the denomination would be, all right, remember this is sigma. Sigma would be variance or standard deviation. If sigma, variance or standard deviation.
Standard deviation.
Yeah, standard deviation. So the formula would be the covariance of the two stocks divided by the multiplication of standard deviation stock A with standard deviation of stock B. Then your answer will be within this range. Okay, so this is where if we get exactly 0, there will be no correlation or there's no relationship between the two. Okay, so if the answer is exactly 1, meaning 1.0, that's the maximum. It shows a perfect, like I said, perfect positive relationship. But you may get 0 point something and between 0.1 until 0.9, you will be still positive relationship. And the higher the score towards 1, it indicates strong relationship. Okay, if your answer is, let's say 0.1, 0.2, it shows a weak or mild relationship. Okay, similarly for negative. So -1 indicates a perfect negative relationship between the stocks. Okay, so let's try. Okay. Even though the question doesn't ask for correlation, untuk soalan ni dia tak tanya, tapi for example, the earlier question number 1, they ask for it, correlation. So look at the question lah. So if the question asks for it, then you calculate lah. But for this one, actually they don't ask for it. But for the sake of, explaining to you, let's calculate lah. Correlation of stock A and stock B. Okay. We need the covariance formula here. We need the covariance. And we, sorry, we need to have the standard deviation. Stock A, 12.13. Then we multiply with standard deviation for stock B is 21.54. So you get here I dapat sini lah 0.96. Okay, almost a perfect relationship, positive relationship, because the score is positive, obviously, and the value is almost one, just a few points before one can. So this is almost a positive, almost a perfect positive relationship between the two stocks. Okay, similar like our predictions just now, by looking at the movement just from the table, we can predict that it will be a positive relationship. But once we do the calculation, we can see the strengths, how strong actually the two relationships. So here we can conclude that the strength of the relationship is quite strong, not quite anymore, it's really strong, almost a positive, almost a perfect positive relationship. Okay, almost one tadi.
Saya nak tanya boleh?
Ya, boleh.
Boleh jadi ke kalau dapat 0.0001 ke tak boleh? Tak jadi. Takkan jadi.
There's always, because the score is between -1 until 1. So any numbers between that, there's a possibility. Boleh je 0.00 something.
Terima kasih.
But for the sake of your answers, nanti just at least keep it to decimals macam ni lah. To indicate that kalau you dapat 0.00, very small 0.12, we still can assume there'll be no relationship lah. Okay, so just keep it to decimals at least. Okay, so that's the covariance, and I also explained about the correlation, even though the question doesn't ask for it, right? But this is how you do it lah, if the question asks for it. Okay, we have one more part, okay? But before we go to that part, I think let's take a short break. Okay, short break. I give you maybe 10 minutes, maybe 10 minutes break. Before we continue with the actually the final part lah, which is the calculation of the variance of portfolio and also the standard deviation of portfolio, right? So let's take a quick break and I'll see you guys in 10 minutes. Right. Let's move on. Next, check the recorder. Okay. So as I said tadi, for the risk measurement, we have another measurement which is known as the beta coefficient. Beta coefficient. And the beta actually represent the systematic risk, okay, for each asset or investment. Right. So just to summarize, okay, the difference between the beta coefficients and also, let's say, if you want to compare against the variance and standard deviation. Actually, under risk, okay, you're gonna have two different categories. One is known as systematic risk. Another one would be the unsystematic risk. Systematic. Okay, and for systematic risk, we can measure using beta. Okay, but for unsystematic risk, we can measure using variance and also standard deviation. But the most important thing to compare between the two is the in terms of how we can manage the risk. Okay, for the unsystematic risk, we can manage the risk, and this management of risk can be done using diversification. Okay, the one that we discussed so far, based on portfolio, based on everything, is diversification. And by having this diversification, we can reduce the risk, meaning we can reduce the score of variance and also standard deviation. Okay, but for beta, which is the systematic risk, it is, we call them as a non-diversifiable. Fiable, FIA. It's not the non-diversifiable types of risk. So meaning, how good we diversify our investment, we cannot reduce the beta. Okay, because the beta basically is another form of covariance actually. Okay, if you remember covariance that we've calculated earlier, is basically the relationship between stock A and stock B, for example. Okay, but when we talk about beta, this is basically a measurement of market risk. Okay, market. So market is considered as external. It's not really something that we can control. It is a non-controllable type of risk. It will be there in the market. So therefore, that's why we cannot diversify this kind of risk. And this beta is basically the relationship between the stock and also the market. Okay, so that's why the relationship is actually, if you see the formula, we use M here. M represents the markets. Okay, the market's covariance with the assets, and also the variance of the market. Okay, the variance. So this is sigma squared is variance, variance of market. So M actually refers to the market, right? So again, we have three possibilities. No relationship, positive, and also negative relationship. So the explanation will be the same, but now we compare between one stock or one asset against the market. Okay, the market movement. Right? You don't have to worry about this one. We will not measure, like I said, we will not measure this in our calculations. Okay, especially for the risk and return so far. But this will be revisited later. Beta coefficient in our future topic, as I mentioned earlier. Right, so I want you to follow me back to the measurement of risk. Okay, measurement of risk with the final part of measurement, which is, if you remember, I said we're going to do the variance and the standard deviation of portfolio. This will be our final measurement. And to calculate, especially the variance, we need to know the covariance. Okay, we need to know the covariance. So the covariance will be part of our formula. Okay, I'm going to skip this part. Okay, so I'm not sure whether you have this this slide or not, because this is the updated version. I changed this slide last Monday, if I'm mistaken, last Tuesday. Right, if you downloaded the slide earlier, you might have a different information, but I already uploaded the updated version in my group. So if you just downloaded it today, for example, you will have a similar slide, or else you might have the old one. Okay, the difference would be how to read the information. The formula is actually the same, but this is much easier to read as compared to the original. So I decided to change, okay, the formula. So to find the variance of portfolio, or the portfolio variance, whichever you want to call it, we have three sections here. Okay, you can split this into three sections. Okay, let's say I put it 3 brackets here, right, in order to calculate the variance. So don't worry about the symbols and whatnot. It might turn you off in terms of, or might be difficult, but it's actually not that difficult. Okay, so let's focus on the first bracket here, the first part of the formula. Right, so W again represented by the weight. Okay, we already calculated the weight earlier when we calculate the ER, right? So it will be the same weight, but for the formula, we need to square the weight. Okay, so it's first weight or weight for stock A square. This is symbol of multiply. So multiply with, so this is again sigma squared. Okay, sigma squared is variance. So if you cannot remember, this is sigma squared, variance or standard deviation. Remember, we are calculating variance of the portfolio. So we want to calculate the variance, so automatically we use variance lah. Okay, so variance of stock A. So this is basically variance of stock A. So meaning it's weight A square multiply with variance stock A. That's it. Plus second bracket weight B square multiply with variance for stock B. Okay, remember we have both variance, both weights, 40 and 60 earlier, and we have both variances, okay, for stock A and stock B. And for myself, again, I will use the one without the percentage. And I will convert it into percentage later. Okay, it's up to you lah, which one you prefer. As long as you don't interchange the percentage. Okay, so that's the second part. And the final part would be, okay, let me check, ada share kan? Ada share, ada record. Okay, sorry. So the final part would be the multiplication of 2. So this number 2 will be fixed. Okay, you have to use number 2. Okay, 2 multiply with weight of stock A. Okay, without square. Kalau tadi we have square. So this is without square. Just weight for stock A multiply with weight for stock B, and multiply with the covariance. Okay, multiply with the covariance. Okay, and we've done this in question 2B just now for the covariance. Okay, and again, covariance I will use without the percentage one. Okay, the one with the numbers without the percentage. All right, so then we will get our portfolio variance. And in order to get the standard deviation of portfolio, simply square root this information or square root the answer. Okay, right, so this is basically the same. So what we need to do is just square root the answer. Okay, we square root the answer to get the standard deviation. And that will be our final calculation. So let's try to find the answer for this. So this is B. So this is actually part of C, the expected returns for portfolio. Okay, 19.1. But to get this 19.1, we need to find the weight first. So this is the working for weight. Okay, already discussed earlier. So we are left with the standard deviation of portfolios. And again, to find the standard deviation, we need to find the variance. So here I will put variance of portfolio. So we have 3 parts, remember? So I'm going to put the first bracket. It's weight of stock A. So the first weight is 40%. So it's 0.4 square multiply with variance of stock A. So remember our variance of stock A was 147.09. So I'm going to put here 147.09. Okay. Okay. Plus for the second bracket will be 0.6 squared multiply with, look back at our variance for stock B. Variance for stock B is 463.89. Okay, and we have the final part, which is, remember, starts with 2, multiply with the first weight, 0.4, multiply with the second weight, 0.6, and multiply with the covariance. Okay, our covariance was this one, 252 is 250.29. 250.29. Okay, so that completes our formula. Okay, so can you please help me to find the answer for this? Yeah, 310.67. Okay, sorry, I missed that. 310.67. Okay. And again, if you want to put it in percentage, just divide by 100. So it's basically about 3.11%. Right? And to find the standard deviation of portfolio, simply square root 310.67. So you get 17.63, yeah. 17.63%. Okay, 17.63%. So this will be our final answer for the question. Okay, so technically we've answered question C. So we get 7 additional marks. So a total of 20 here. Right, so what can we conclude from this exercise? Okay, as you can see here, the measurement of risk is variance and standard deviation. Let's say we just focus on standard deviation as our final measurement of risk. Remember, for variance and standard deviation, the higher the score, the higher the risk. Okay, the higher the score, the higher the risk. So if we look at individual standard deviation, for example, the score was 12.13 and 21.54 respectively for stock A and stock B individually. Okay, based on individual, we can say that stock B is higher risk as compared to stock A because the score is higher, right? 21 against 12%, right? And we can see here lah. If you look at the original question in the table, yeah, in normal time, yeah, stock B is offering lower returns as compared to stock A. Okay, 20% and 16%. Okay, meaning in normal case, stock A might offer you higher returns, but during a very good economy, you might get higher returns. You can see here lah, it's between 50 and 32%. So this stock B offer you higher returns. However, it comes with higher risk because they can drop into a negative returns. But for stock A, you still can get returns, but with a 1% return only. Okay, so that's why in terms of the risk, stock B is much higher lah in terms of the risk. Okay, but when we do the portfolio exercise with this segregation between stock A and stock B, If you remember, the weight is 40 and 60%. So meaning if we have 100,000 ringgit, so I will put 40,000 in stock A and 60,000 in stock B. Okay, if we do that kind of diversification, we will get, or we can reduce our risk. You can see here, okay, at a combine of 17. Okay, obviously it's quite high as compared to the stock A, but we managed to reduce. Okay, we managed to reduce our investment if we invest everything in stock A alone. Okay, if we invest, sorry, in stock B alone. So if I have 100,000, let's say, if I have 100,000 and I see that, okay, stock B can offer me higher returns, I'll put every money that I have in stock B. I will have this risk 21%, almost 22%. Okay, but if I want to diversify, okay, I managed to reduce my risk to 17.63%. Okay, so that's what the purpose of diversification. Obviously, this is based on 40-60 ratio lah. But again, if you have different ratio, you might have a different standard deviation. Might be higher or might be lower lah. So again, the higher the ratio, the higher the risk. So as an investor, it depends on your risk appetite, whether you're willing to take high risk or not. If you think this is still high, you can minimize the standard deviation by having a different weight, meaning you spend more maybe in a secure risk, which is stock A. Stock A have a lower risk, kan? So maybe you increase your investment in stock A instead of stock B. Okay, so yeah, that's how we manage, or that's how we calculate the risk and also the return based on the portfolio. So I think that's about it. I think I want to discuss. So the rest of the topic is actually to summarize. Okay, like I said, why we want to develop an efficient portfolio, because we want to manage our risks via diversification. Okay, so based on the exercise just now, we combine two, right, the minimum, which is 2 investments. And the result shows we managed to lower the risk, okay, which is the standard deviation. Yeah, by a certain percentage lah. So in order to have the best effect of all, is actually to combine. Remember, our 2 stocks just now, we have a positive relationship. Okay, but to have a better portfolio, like I said earlier, it's best if you have a negative ataupun low positive, or the best is actually this part lah, a low or mild negative correlation between the 2 stocks. Okay, that will reduce our standard deviation tremendously in terms of the score, right? So the negative correlated can reduce the overall risk, as I mentioned. So if you combine a perfect, 2 stocks or more that have a very minimum negative relationship, obviously we can minimize the risk. Okay, I will not go through these 3 assets portfolios, but most of the times, we will use, or we will utilize 2 assets portfolio only. Okay, not 3, not more than 3 lah, but you can use this as an exercise later on because we have the answer kat belakang ni. Right, and we also have another question here. With the 4 probabilities, remember, again, based on our earlier examples, I just use 3 probabilities. Okay, but here we have one example with the 4 probabilities. You can try on your own, but the total probabilities, either 3, either 4, it must equates to 1, as I mentioned. Okay, so you can try this. I'm not sure whether they have answer for this, but if you want to know later on, you can ask me what would be the actual answer for this. Right, so don't worry about KPM. As I said, this will be revisit when we talk about the capital market, because when we talk about capital market, obviously it will involve the markets. So as I mentioned earlier, when we talk about beta coefficients, okay, it will involve the market as well, right? So we will revisit this later lah. So ada answer kat sini, nanti you look balik lah kat sini. Okay, so I think that's about it. Just focus as a recap, just focus on for the portfolio, for the return. We just have expected returns of portfolio. And then in the middle, you can see the relationship in the form of covariance and correlationship. Okay, correlation. And as for the risk, still we're gonna have variance and standard deviation of, okay. And to ensure you can calculate the variance and also standard deviation, you need this covariance, right? And this covariance and correlation is to measure the relationship between the two or more stocks. All right, so I think that's about it for today. As I mentioned last week, for this topic number 3, we're gonna have a quiz. I dah prepare the question I tak upload lagi, I just prepare dia punya space in my guru tu. Cuma I tak upload the question. So I will upload the question by today lah. I will revise back the time and everything. Okay, and I will give you until Monday, so you have ample time to do it. Similar, just like what we've done in the exercise, the one I showed you in the whiteboard just now. Something similar, all right? Similar concept even. So please submit it latest by Monday. Again, please check in the My Guru lah for the deadline. I will set it on Monday, maybe 5 or 6 p.m. in the evening. Okay, so before we end, any question? Okay, by the way, I think I already mentioned last week about the videos. So now the videos, everything will be dalam My Guru tu lah, in the web conferencing. Okay, in the web conferencing. I shared it on weekly basis, and if you click on the my YouTube channel, YouTube channel, I also created a playlist, meaning the playlist will follow the sequence of our chapters. So later, once this video available, I will upload again the YouTube, and then you will see the sequence of by every week according to the chapters, okay, according to the topics, for your reference especially for the future reference. All right. So if there's no other questions, I'll see you guys next week. We will continue with topic
Doktor.
4.
Sebelum ni saya ada saya tengok ada kuis dekat My Guru, tapi tak
Yang tadi saya cakap
memang ada. Tak, yang sebelum ni.
Sebelum ni, bila sebelum ni?
Ada dekat dalam tapak My Guru.
So,
sebelum ni memang ada.
Tapi tak buat lagi, just tapak.
Ingatkan ada.
This will be the very first quiz for topic 3.
Okay, thank you, Doktor.
So nanti check balik lah for the quiz. Mana I tak upload lagi the question. Okay, any other questions? Okay, as I said, next week we're gonna continue with topic 4. Okay, but topic 4 it will be very quick, and we might proceed with topic 5 as well. So topic 5 might be longer in terms of the time required for explanation. And I don't think so. We might finish everything in one go for topic 5 too. So meaning for next meeting, it's gonna be topic 4 plus partial for topic 5, and the remaining topic 5 will be discussed in the following week. But heads up, there's a possibility of for next week, I might not be around. I might not be around on Thursday. If I'm not around next week, I will share with you a video okay, consisting the topic 4 and partial topic 5 with you guys later. Okay, but for now, just assume the class will be normal, but just a heads up, like I said, there's a possibility that I might not be around, but if I'm not around, I will share a video with you on Thursday as well. Okay, and I will let you know in the group, okay, if that's the case. All right, so thank you very much, and inshallah, I'll see you guys next week.
Thank you, sir.
You're welcome.
Thank you,
Thank
sir.
you very much,
Thank you,
Doctor.
Doctor.